Thank you, Goelji, for that kind introduction. Distinguished guests at this conference, a very good evening to all of you. At the outset, let me thank the Indian Banks Association and FICCI for inviting me over to deliver this address today. It's indeed a pleasure to be here amidst such a gathering of important stakeholders across the spectrum of our financial landscape. Um, In a very short span of time, FIBAC has achieved a prominent status of being a premier brainstorming event on emerging themes of relevance to the financial world. I'm sure all of you have had a very open and insightful set of discussions on several important issues over the last 2 days. The theme of FIBAC 2023, Winning in Uncertain Times, is very apt in the current scenario. Therefore, my remarks today would center around this theme, that is, managing the uncertainties that we are living with and those which lurk in the horizon, and later dwell upon how we could navigate such uncertain times. When we think of uncertainty, we immediately think of risk and risk taking and risk management. The people in the field of finance often have a love hate relationship with risk. While most entities are willing to assume risks on their balance sheets, sometimes there are reservations to plan and provide for it, often due to the costs involved. While there are obvious incentives for taking risks, an overdose of risk in a leveraged entity is like a bank or a finance company can be disastrous if it's not managed efficiently. Therefore, the regulators and policymakers endeavor to make the policies to facilitate overall financial stability and occasionally give out didactic fiats and guidance stressing on the importance of systemic resilience. Beg your pardon. To give you an analogy, the prudential guidelines are akin to a diet plan given by a physician. If you stick to it, your balance sheets would look healthy. Then, as supervisor, RBI also conducts an annual health checkup in the form of on-site visits to see what looks apparently healthy from outside reflects the correct position with no hidden illnesses. If indeed there are symptoms of illnesses, medication in terms of a time-bound action plan to not only treat the symptoms but also address the root cause is prescribed. In a way, prevention is better than cure is an apt mantra for the financial world as well. Drawing a reference to the 5 natural elements which human body is composed of, let me outline my version of 5 elements that make the foundation of a robust and resilient financial system. These are strong governance and management, sound regulatory principles, adequate capital and liquidity, strong supervisory and risk management practices, and finally, effective crisis management and resolution frameworks. I do not think that I need to elaborate much on these elements as these are quite familiar to this distinguished audience here. Our microprudential risk management framework revolves around 2 very simple yet powerful measures, provisioning and capital requirement. One for the anticipated loss component of the asset portfolio at risk and another for the unexpected loss component. The third component, that is the liquidity, has been under a lot of discussions in the global forums of late. However, it may yet be worth reiterating that in India, we implemented the statutory liquidity ratio way back in 1949, which required the banks to maintain a level of high quality liquid assets, mostly in the form of government securities, to essentially address this concern. The importance of these measures have been reinforced repeatedly through frequent international episodes of financial crisis. Perhaps the higher quantum and better quality regulatory capital requirements have helped the financial system around the globe to navigate through the turbulence in the wake of COVID and other crises that we have experienced of late. A resilient financial system is one that can withstand and quickly recover from the episodes of such financial shocks and crises. Such a financial system also requires early identification of vulnerabilities and risk buildup in each of these entities, both at the entity level as well as the system level, and initiation of appropriate corrective action. So it's of utmost importance that the banks as well as other financial entities are always vigilant regarding the build-up of risk pockets in their balance sheets and operations, adopt prudent risk management practices, and are transparent in disclosing the risk to the regulators and other stakeholders. But given these risks and the changing paradigms, let me, sorry, I think it's missed out a bit, sorry. The recent crisis episodes in the US and Europe have brought back the question of robust and sustainable business models again to the fore. The business models of the banks have evolved depending on the roles they have played throughout history, with the current focus being on the intermediation paradigm, that is, acceptance of deposits and credit creation. However, this approach needs to change with newer players entering the financial service space and disrupting the traditional rules of the game. In the newer paradigm, markets are likely to become the central point of intermediation where the banks may become but one amongst the host of other entities interacting in the marketplace. The traditional business model needs to pivot to address this evolving paradigm. Another important transition which is underway is the changing consumer preferences. While this customer-driven evolution is often slow, it is mostly defensive and non-reversionary. It is mostly definitive and non-reversionary. The future of banking cannot be imagined without visualizing the needs of the post-generation Z consumers, those that are yet to be tagged by an alphabet. The future generation of customers are likely to consume financial services in the same way that they consume other products and services, and banks may have to be prepared to make that transition. Therefore, let me imagine the contours around a few aspects of where we would be likely to see banking in the next decade or so under the marketplace-based and the consumer preference-driven paradigm. Let me emphasize here that what I am going to tell you lies in the future, more in the realm of probable, but the undercurrents of this transition are already visible. The first point is that the banks will have to transition from a sectoral approach to an ecosystem approach. The oft-repeated pitch that all banks of future will actually be technology companies also undertaking the business of banking. While it's difficult to ascertain that this will indeed be the case, it is likely that the era of exclusiveness of providing banking services by banks are over. With the banking as a service model making steady and silent inroads, the banks have to operate as part of a larger ecosystem with good number and varieties of non-bank players in the mix. A lot of these transformations are already becoming visible. Banks and NBFCs are partnering with fintechs to deliver financial products and services by deploying innovative methods and technological solutions. Second, the banking of future is going to be hyper-personalized, and banks may have to shift from isolated service provisions to hyper-personalized embedded banking. In future, probably banking may cease to be a separate service. Instead, banking would be embedded in all the products and services which the consumers are expected to avail. Embedded finance is the integration of financial services or tools within products or services of a non-financial organization. So, in future, customer may not have to visit a bank branch to avail a home loan. For example, when you log into the Builders app to book a flat, the app could be integrated in through the bank's app or to a fintech's platform, and when you enter your KYC identifier, the loan eligibility would be automatically calculated using your consent to pull your financial and non-financial information through an account aggregator or a DigiLocker, and the loan would get disbursed. All this would take place within a few minutes, if not seconds. Technological solutions would allow banks to offer prices that would continuously adjust to customer behavior and preferences while responding to supply and demand position, margin requirements, and competition. All this hyper-personalization would become possible as we increase our digital footprints and the banks or their partnering digital companies learn how to get artificial intelligence, or machine learning-based decision outputs from this data. Third, the current form of business segmentation may give way to customer preferences-based verticals. The focus of tomorrow's bank has to go beyond just its business to better meet the customer's needs. Hence, the segmentation will be based on homogeneous customer groups, and all products would be designed to serve these segments. Hence, the core strength of the successful bank would be the customer segment specific. Even now, some banks, often in partnerships with fintechs, are trying to target some specific segments such as the MSMEs, women, senior citizens, and millennials. We already have examples elsewhere where the traditional banks have failed to innovate and adapt to the customers, the new needs of the customers. Disruptors such as the new bank in Brazil have come in and captured the market, filling the vacuum and offering products and services that were demanded by the customers. Finally, the traditional breakup of assets and liabilities may likely undergo drastic changes. Currently, the balance sheet of Indian banks are dominated by loans and assets on the asset side and deposits on the liabilities. We could expect transformation of the composition of the bank balance sheets during the forthcoming decade, driven by the natural progression of the Indian economy. This transformation will be further propelled by the widespread integration of technology into business operations and decision making. It is possible that the customer preferences in future may shift from passive saving products like a fixed deposit to more esoteric and market-linked investment products. Alternate avenues will compete to tap the depositor's money on account of better returns and convenience of a finance super app to meet all the financial needs that may become the norm. Tokenization of assets and liabilities using the power of distributed ledger technology may change the bank balance sheet in structures. All these changes would mean adjustments to the traditional asset liability structure of the banks. So given these risks and changing paradigms, let me share a few thoughts so as to how we will have to manage these challenges. As the bank balance sheet transforms, we, and when I say we, I mean both the Reserve Bank as well as the banks, would have to refocus our priorities from a risk management perspective. From the regulatory side, we may have to relook at the risk management frameworks, especially for liquidity and market risk. From the bank side, active monitoring of deposit concentration and diversification of funding sources may become even more important. As the March 23 banking crisis in the United States and events at Credit Suisse showed, despite having capital and liquidity comparable or in some cases better than the industry level or the peer levels, the banks failed. Therefore, to address these concerns, we may have to look at qualitative matrices such as enhanced disclosures, strong code of conduct, and clear governance structures. Simultaneously, the self-regulation by the industry through self-regulatory organizations needs strengthening to promote responsible conduct and innovation. We have to focus on fortifying the cybersecurity and prevention of cyber frauds in a hyper-personalized and high-tech banking environment. The banking landscape is fast evolving with increase in financial inclusion, customer access, product choices, and convenience. However, the risks to the consumer have increased. There are increasing instances of frauds and data breaches. Customers today are facing a threat from technology-induced frauds such as fraudulent apps, breach of privacy, and deep fakes. Even mis-selling has emerged in a digital avatar called the dark patterns. Dark patterns are designs, interfaces, and tactics used to trick users into desired behavior such as availing of high-cost short-term consumer credit masquerading as an instant loan. We must work hard, work smart, and work together to protect the customers from these threats to retain and strengthen their trust. A key element of protecting customers is to provide them with an efficient, prompt, and cost-effective grievance redressal mechanism. Unfortunately, it appears that the efforts of the banks to provide timely solutions to customer grievances have not kept pace with the explosion in technology and products. While the banks are hugely invested in forging new and innovative ways of customer acquisition, very little thought seems to have gone on to improving customer grievance redressal mechanisms. To me, it seems very odd for a sector which prides itself on being a service industry. This seems very odd for a sector which prides itself on being a service industry. We definitely wish to see more serious thought and intent emerging from the boards and top executives on the quality of grievance redressal instead of just monitoring the turnaround times or the MIS on complaints. A related point which would help the banks in winning customer segmentation paradigm is bringing in greater empathy into their services, products and operations. For example, there is a need for greater effort to provide safe and friendly tech banking to senior citizens. Banks must require their employees to treat senior citizens or people with special needs, those that are technologically challenged, or someone who may need help otherwise with special care and empathy. The boards must ensure that their access points, the branches, the websites and apps are user-friendly and convenient for the customers with special needs. From the regulatory side, we are taking up these subjects more vigorously in our interaction with the industry. But there's also need for a cultural and attitudinal change within the fraternity, which I would like to emphasize. To conclude, I would like to say that over course of time, it has been said several times that we need banking, but not banks. The prophecy has not yet come true. I'm certain that the banks will continue to be the primary drivers of the India's growth story. But the trajectory that the banks will adopt during this transition will determine how the banking landscape will look like in the next decade. As far as regulations are concerned, they have to keep in view the overall financial system stability, ensure resilience of the institutions, and attempt to bridge the information symmetry. While we laud the fact that the next-gen banking is fast becoming a reality aided by innovations in the fintech space, we also need to continuously work to redefine the regulations and the regulatory frameworks to support these innovations and deliver on our mandate of financial stability while protecting the customers. At the same time, innovations and collaborations need to be well thought out, risks properly analyzed, and mitigation plans put in place before offering the products to the customers. Thank you once again for this opportunity to share my thoughts with you on this momentous occasion. Thank you.